That cycle is the financing cycle. The cycle is going to involve debt and equity because we're going to raise money for our company to conduct its operations through both debt and equity. First, we're going to start with debt, and this is us borrowing money. What are we going to do for our account balances for completeness? We're going to review the board minutes, see if they're talking about raising any money for any debt, and see if that's not included. We're going to trace debt contracts through financial statements. Hey, it says you borrowed $10 million. Where is that on the financial statements? Agree the debt listing to the general ledger. Pretty straightforward there. Make sure that any items listed as debt outstanding is actually reflected on the general ledger. Send out confirmations to any individuals that we know the client's borrowing money from, any entities that they're borrowing money from, and confirming that the amounts are correct. Lastly, inquire of management and obviously follow up on that. For valuation, allocation, and accuracy, we want to examine new debt agreements and recompute interest payable and amortization. Just kind of like dealing with investments when we're receiving interest here, we want to make sure that we recompute and recalculate whatever's payable. For existence and occurrence, we could send out confirmations, sending those to people generally will be banks or financial institutions that are usually going to be the ones who lend us money. So we as the auditor are going to send confirmations to those entities and confirm what debt is actually outstanding for our client. Rights and obligations, we're going to examine note and bond agreements to ensure that we see everything we should. For transactions, with completeness, we want to examine note and bond agreements, review interest expense payments, and examine any lease agreements. Make sure those are all properly included on the financial. For cutoff, we want to review debt activity before and after year end. For valuation, allocation, and accuracy, we want to test any debt receipts and payments and compare interest expense to debt balance for reasonableness. That's pretty important, making sure that, okay, well, it says you have zero debt, then why do you have $50,000 of interest expense? That would be concerning. For existence and occurrence, we want to review the board minutes and inspect any agreements. And for understandability and classification, short-term, long-term classification, important there, making sure we classify current portion of long-term debt as well as long-term debt. For presentation and disclosure, read the footnotes. We have required disclosures. Make sure they're there. And then for existence and occurrence, compare it to audit evidence to determine occurrence, making sure you look at all the evidence you've accumulated for these other transactions, for these other instances, and look for any issues. For our understandability and classification, read the disclosures. If they need to disclose any debt covenants, make sure those are properly disclosed and that they are in the correct form. Lastly, for equity, this is you're selling your own stock for cash, selling partial ownership to raise money, to then use that to invest in machines to then conduct your operations. Here, what are you going to do? You are going to send confirmations and examine stock certificates to verify any incomplete listings of stock. Or you're going to put the shares outstanding and agree to the general ledger. You want to confirm if there are any massive shareholders. You want to make sure that and we'll talk about this later, but any significant shareholders are disclosed. That is, ensure required disclosures. If maybe there's a rule that says anyone who holds 10% of the company needs to be listed on the financial statements in the notes, that may be a possibility. And lastly, you want to examine the treasury stock and agree to the general ledger, confirming all these accounts. For valuation, allocation, and accuracy, you want to recompute value assigned to the stock transaction, just ensuring that the correct dollar amount's there. Check par value, check gains and losses, APIC, anything like that. Analyze retained earnings account from inception or last audit, making sure that you can tie out all the equity accounts. For existence and occurrence, you want to vouch transaction records to the board minutes, making sure that, in the board would have to agree to sell new batches of shares. You want to see if those shares that were sold, you can tie back to the board of directors saying that we're going to sell them. You want to send confirmations. If they say that an entity holds 5% of their stock, you want to send a confirmation to that entity and say, hey, do you actually own 5% of my client's stock? Lastly, inspect those stock certificates, make sure they are real. Lastly, here for understandability and classification, you want to determine if there are restrictions on retained earnings from loans, agreements, or state law. That could very much be a possibility. And lastly, you want to inquire of management regarding appropriations or restrictions on items. Powering through the financing cycle, we are having a good time. Well, when auditing the financing cycle, which is the raising of capital through debt and equity, as we mentioned, it's important to assess the way in which the company is raising capital. Auditors should review the company's financial statements and cash flow statements and other relevant documents to ensure that the financing is properly reported and accounted for. The auditor should also review any agreements or contracts related to the financing, such as loan agreements, to ensure that they are properly documented and in compliance with applicable laws and regulations. Just follow the process. You need to issue some stock, look at the documentation for that. You accept the money from the investors, look at the documentation for that, look at what they did with that money. Same with debt. Look at the agreement with the bank, look at documentation for every single step along the way. In addition, the auditor should review the company's internal controls over the financing cycle to ensure that the process is properly managed and monitored. This includes assessing the company's policies and procedures for raising capital, reviewing its procedures for monitoring the use of funds, and evaluating the effectiveness of internal controls over the financing. Very sensitive process. I mean, obviously, you can think about there's a lot of cash involved once the cash is received. The usage of that is very sensitive as well, making sure it's used for the betterment of the company. And then also any covenants, any legal regulations you may have to follow, anything like that. Definitely a lot to consider. Finally, the auditor should evaluate any potential risks associated with the financing, such as the potential for fraud or misappropriation of those funds. The auditor should also consider the impact of the financing on the company's financial statements, such as the potential effects on the company's cash flow or debt to equity ratio. These may have to be disclosed, and these may have to be communicated to third parties. By performing a thorough review of the financing cycle, the auditor can help ensure that the company is following best practices and taking the necessary steps to protect itself from any potential risks. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.